Hi to IPO subscribers. Welcome to eaglelive.ai. Today, let us review IPO from Skyway Airways Services Limited. Here we go on IPO presentation. This is the financial analysis and status of the company generated by AI-powered software. So, based on the metrics given to the software, this company has been categorized as an unhealthy company. Let us see what are the financial weaknesses that are there to categorize this company as an unhealthy company. First is health analysis solvency. Solvency, I told you, no, it ensures the sustainability of the company. Here, this DSR is, of course, close to 1.5. And coming to gearing ratio, gearing ratio should be less than 3. It is 3.04. And coming to debt to assets ratio, should be less than 0.6. It's 0.67. Interest coverage ratio, of course, no problem. Net worth to assets ratio is it should be more than 0.34. It is 0.2. This is the main reason. And another thing is coming to liquidity. That is the survival of the company. Current ratio is 1.16. It should be 1.33. That means the company has not brought in their full amount of working cap margin. So these are the two reasons why this company has been categorized unhealthy company. See, the company has to brought in some equity for strengthening the balance sheet of the company. That is to make the company solvency strong. Okay, coming to operational efficiency, gross margin, okay, 11.71, that depending on the industry, and no financial irregularities. EBITDA 152.42, EBIT is 135, and PBT is 87.68, PAT is 66.56, cash profit 50.22, DPS 3.56, very low amount, EBITDA margin 5.36, very low, net profit margin 2.26, and ROC is 18.1, ROE is 14.15. So book value per share is 28.56. So cash flows from operating activities is 113.62. And the net cash flows for the year is a minus 13.41. It's a negative. So market value. So based on the market cap price of 138, price earning ratio is coming to 38.76. It's a normal, aggressive value, I should say. Aggressive value. It should be less than 25. And price to book value is 4.83. It should be less than 3. This is also negative. So coming to growth indicators, EPS growth is minus, and rest are positive. So this is the financial analysis and the status of the company. And based on the financial analysis, this company has been categorized as an unhealthy company. Now let us go on IPO presentation. So this is the IPO presentation. SKYWAYS Air Services Limited. SKYWAYS Air Services, a 40-year logistic leader, but is the IPO valuation too expensive? Let us see. SKYWAYS Air Services is entering the IPO market with a 582.80 crores issued at a price band of 131 to 138 per share. The IPO is scheduled to open from 24th August and close on 27th. So coming to, it was established in 1984 and experienced 40 plus years in logistics and freight forwarding, integrated logistics player covering air freight forwarding, ocean freight forwarding, trucking and transportation, warehousing, customs, broking, express cargo, and parcel delivery. Strong presence across India, major manufacturing and export hubs, international connectivity through airline relationships and global logistics network, technology platform support freight booking, tracking, documentation, and workflow automation. The company has reported a strong industry position in air freight and forwarding with extensive airline and geographic relationship. Growth story, India's manufacturing plus exports plus e-commerce plus cross-border trade is equal long-term logistic opportunity. Very good. Valuation, that is the big question here. At 138 IPO price, EPS is 3.56 and PE is 38.76. PB is 4.76. Both are aggressive values. So coming to a feature-based valuation, projected P is coming to 20.4, projected PB is coming to 3.4, almost close to benchmark ratios. But still, let us see what are other factors. Good business, but expensive valuation. And this projected is provided they achieve the whatever we have percentage we have given, projected percentage, CAG, then they must be in a position to achieve, then only can say. So at nearly 39 current earnings, that is 39 PE current earnings, investors are paying a significant premium for Skyway growth and market position. The valuation becomes more attractive only if the company delivers strong future earnings and book value growth. Valuation status premium, margin of safety low. Where is the IPO money is going? Fresh issue 398 crores. 216 debt repayment, prepayment, 130 crores working capital, balance general corporate purpose, YFS 184 crore. YFS proceeds go to selling shareholders, not to the company. Investor takeaway, the fresh capital has a constructive purpose because debt reduction can strengthen the balance sheet, but the IPO valuation remains demanding. Key risks. Economic offense, FIR involving the company, material subsidiary. The company is financial unhealthy. About 43, nearly 43.9 crore disputed tax demands are there. Loss-making subsidiaries, related party transactions concern, corporate guarantees to subsidiaries, historical ROC Companies Act compliance issue, highly competitive logistic industry. Market sentiment. The IPO is positioned as the main board issue with allocation of up to approximately 50% to QAB, QABs, 10% to NIs, and 35% to retail investors. The broader IPO market remains active, but investor sentiment has also been affected by market volatility and institutional flows. Sentiment before subscription, neutral to cautious, of course. Why? Established business, strong logistics sector opportunity, large fresh issue for debt reduction and working capital, but expensive current PE and governance and legal concerns, subsidiary risks, limited valuation comfort. Actual subscription levels and institutional participation should be watched closely during 24th to 27th August. So, legal ID factor and view. Business strong, industry opportunity positive, market position strong, financial health healthy, valuation expensive, governance caution, legal and regulatory high risk, market sentiment neutral caution, overall IPO view cautious. Final investor message. SKYWAYS AI Services offers a strong logistic franchise and attractive long-term industry opportunity, but nearly 39% price earning ratio and 4.77 book value, investors are paying a premium. Eagle live view, cautious, wait for better valuation. Final question, strong business, but is the IPO valuation too expensive? So, investors, you have to decide. This is the information about the company. So, as always, investment decisions should be based on your own financial goals and risk tolerance. Thank you for watching. If you found this analysis useful, please like the video, subscribe to the channel, and stay connected for more detailed IPO and stock market research. Thank you very much for watching video.